Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. Thank you for taking time to listen to the LPL Research Weekly Market Commentary, dated January 16th, 2018, and titled Global Equity Market Outlook, Favor United States and Emerging Markets. This was written by John Lynch, Chief Investment Strategist of LPL Financial, and Jeffrey Buchbinder, CFA, Equity Strategist of LPL Financial. We favor U.S. and emerging market equities for tactical global allocations. After reviewing our thoughts on the U.S. equity markets in last week's weekly market commentary, we thought we'd expand our 2018 equity outlook with a focus on global markets. As discussed in our Outlook 2018 Return of the Business Cycle publication, from a regional perspective, we favor the United States and emerging markets over developed foreign markets broadly, although the improving outlook in Japan is noteworthy. International Equities Performance Review. The year 2017 was excellent for international equities, especially for emerging markets. The MSCI EAFE and emerging markets indexes returned 25.6% and 37.8% respectively, both ahead of the S&P 500 index's 21.8% return. International equity market gains were broad-based, as only two MSCI world countries saw their markets decline in 2017, Russia and Israel. In general, overseas equity markets benefited from U.S. dollar weakness, improving and better than expected global growth, a rebound in earnings, and commodity gains. Within the developed international benchmark, Europe slightly outperformed, while Japan slightly underperformed. Within emerging markets, where strength was led by China, some of the risks carried more bark than bite. U.S. trade relations with China and Mexico soured less than feared, while emerging markets generally shrugged off Federal Reserve rate hikes and the start of balance sheet normalization. International Equities 2018 Outlook. We evaluate regional allocation opportunities by looking primarily at the following factors. Economic growth. From a regional perspective, our 2018 economic growth outlook favors the U.S. and emerging markets over developed international economies. For 2018, we forecast gross domestic product, GDP, growth of 2.75% to 3% in the United States. After factoring in the potential impact of the new tax law and 4.8% in emerging markets, compared with 1.8% in international developed economies and 3.7% globally. See Figure 1 in the PDF document. Growth in the Eurozone gained traction over the past year, with improving business confidence leading to higher investment as the worst of the political fears failed to materialize. However, uncertainties remain amidst the surge in nationalism. Brexit, negotiations, and the upcoming elections in Italy. Considering these challenges, along with a reduction in European Central Bank monetary support, it is conceivable that European growth may have peaked. In Japan, economic growth prospects have brightened. The combination of government spending and monetary accommodation has pulled GDP higher for 7 consecutive quarters. While GDP growth is expected to hover around 1%, inflation is projected to remain well below the Bank of Japan's 2% target, which may keep the 0% target for the 10-year Japanese government bond in place for the next year or two. Prime Minister Abe has a mandate for more stimulus and structural reforms after his election victory last fall. We expect economic growth near 4.8% in emerging economies, advantageous demographics, stable commodity prices, and early cycle acceleration should help offset slowing but stable growth in China. We expect China's GDP to expand near 6.5%, down slightly from 2017 estimates of 6.9%, supported by the powerful combination of gains in retail sales and industrial production. Earnings growth. Consensus estimates are calling for strong earnings growth in developed international markets, up 9%, based on the MSCI EAFE index, according to FactSet. But earnings growth expectations in the U.S., up 14%, and emerging markets, up 13%, are both higher. Moreover, revisions to 2018 estimates over the past month have been more positive in the U.S. and emerging markets than in developed international. Although solid earnings growth is anticipated in international developed economies, it is difficult for those earnings to stand out when compared to the acceleration driven by the tax law in the United States and faster growth rates in emerging markets. See Figure 2 in the PDF document. Valuations. Valuations are lower in developed international and emerging markets than in the United States by virtually any measure. While this factor is perhaps the strongest one in favor of developed international allocations and points to a healthy strategic allocation because valuations matter more long term, we see potential for better value tactically in emerging markets given the macroeconomic backdrop. See Figure 3. Relative to long-term histories, 25 years, on a forward priced earnings basis, the United States is trading at a 25% premium. Developed international is trading at a 4% discount, and emerging markets is trading at an 8% premium. However, low valuations in Japan are skewing international developed. Europe is trading at a 23% premium, and Japan is trading at a 33% discount. Political stability. Relatively speaking, we believe political stability favors the United States, Japan, and China over Europe. Republicans align to pass the new tax law, and the United States continues to have among the most stable business environments. Japanese President Abe and Chinese President Xi have both consolidated power. President Abe is pursuing a market-friendly structural reforms, while President Xi is emphasizing balance between market-driven forces and state-owned enterprises. Elsewhere in emerging markets, India is becoming the new China under a generally pro-business Prime Minister Modi regime, and Brazil is emerging from political scandal and recession, although an unusually active election season throughout Latin America in 2018 bears watching. Political stability in emerging markets is atypical, but the picture is relatively encouraging at this point. The political backdrop in Europe will be important to watch and could change dramatically depending on developments in the United Kingdom, such as Brexit, Italy, March elections, and Germany in the process of formalizing a governing coalition. Watching for U.S. dollar reversal. Currencies are also an important consideration in regional allocation decisions. Last year, a 15% gain in the euro relative to the U.S. dollar helped drive the outperformance of the MSCI Europe Index relative to the S&P 500. We expect modest upward pressure on the U.S. dollar in 2018 as the Fed gradually hikes interest rates and allows maturing securities to roll off its balance sheet, pushing market interest rates higher against the backdrop of ECB, European Central Bank, tapering and continued aggressive monetary policy stimulus from the Bank of Japan. For appropriate investors, we suggest hedging currency exposure in developed international markets when possible, given our expectation that the U.S. dollar may rise. Conclusion. We favor U.S. and emerging market equities over their developed international counterparts in 2018. In the United States, a slight pickup in economic growth and fiscal stimulus, including the new tax law, are supportive of a continuation of the bull market. We expect strong economic growth and attractive valuations to help emerging markets offset tighter global monetary policy in 2018. In developed international markets, though our outlook for Japan is positive, growth in Europe may be peaking, while structural concerns remain. Thank you again for listening to this podcast. I hope you found the information helpful. You can find a link to the LPL research report in the summary section of this YouTube video. You can also find it at christensenwealth.com under the research tab. Have a great day and look forward to talking to you soon. Bye-bye.